One of the things I think the market is misunderstanding about Disney as a stock right now is the opportunity the company has in streaming. We know that Disney has a phenomenal business in parks and entertainment. That's where it's investing $60 billion over the next 10 years. It's where the most profits are coming right now. And direct to consumers or the streaming business is losing money, burning cash. That's what investors have been very disappointed about over the last year or two for Disney. But long term, this is a company that I think is going to end up being one of the winners. There's probably only going to be one or two companies in streaming who have the scale and the pricing power to be able to make money in the streaming business. I think a lot of these other content companies are going to just end up licensing their content to those one or two winners. I think Netflix is clearly going to be one of those winners. And then the other with the most scale is going to be Disney. Over 100 million subscribers with Disney Plus. They're going to buy out the rest of Hulu that they don't already own. And then you have ESPN Plus to be that sports side. That's going to be the linchpin going forward. If they're able to build a streaming business in sports and then bundle that with general entertainment and family entertainment, that could be a phenomenal business. So with that context in mind, I want to go through a few of the items from the most recent earnings report. We've had a few days to process this and think about what it means for Disney's future. But I think there's a lot to like in this report. And I'm going to go through some of the details specifically on the direct-to-consumer side and the sports side to show where I think we're already seeing progress. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And don't forget to check out this video sponsor, The Motley Fool, at fool.com/ASYM for their top 10 stocks to buy right now. And I'll just start with a few things from a high level from Disney's results. This linear business, this is something that we have known for quite a while is in decline. The question is, how quickly is it going to decline? And 9% was the drop in linear network revenue. But keep an eye on this number. Operating income was about flat. So that's pretty impressive that they're able to control costs in that way as they're losing subscribers. Keep an eye on these margins, especially this operating income line in the future. Direct to consumer, you can see 12% jump in revenue. I'll get to the number of subscribers in just a second, but there was growth there. There's also some increases in pricing. But the big thing is the cost cutting that Bob Iger has put in place since he came back as CEO. Operating loss was $1 billion lower in the most recent quarter than it was a year ago. So just phenomenal progress there. And I think in the next few quarters, we'll see that turn to being a positive number. The biggest thing to watch with Disney's streaming business is what the subscriber numbers are. Because this is really going to tell you, are you getting subscribers as quickly as competitors? And are you kind of taking market share and eyeballs in that respect? And it appears to be that is the case. This is just one quarter in change here. So September 30th, 2023 compared to July 1st, 2023, you can see that there was 6.4 million additions just in Disney Plus international markets. There was a small increase in the US and Canada, so that's progress, but the real growth was in international markets. So that is phenomenal to see that kind of growth for a streaming service that had 105.7 million subscribers 3 months ago. Now that's up to 112.6. You add that in with Hulu, and you get over 160 million subscribers to those services combined. Prices are also ticking up just a little bit. Disney Plus Hotstar, this is why they break this out separately, because that's not really contributing much. But international is not all that much lower than it is in the US and Canada. I'll go through some price increases in just a second. Hulu, video only, and then with the addition of video on demand, and then with the addition of live TV, you see the $12.11 and $90.08 price points. The other thing I wanted to highlight is the sports business. Now, this is now where ESPN Plus lives, but you can see that there was a 1% increase in revenue, so pretty stagnant on a revenue side, but operating income for ESPN was up 15% to $953 million. So strong results there. And right here, you can see that the paid subscribers to ESPN Plus were 26 million, and they were paying an average of $5.34 per month. This is one that I think we'll probably see change over the next few months as they incorporate Disney Plus, Hulu, and ESPN Plus into one app and try to bundle those together a little bit more, but we'll see how that goes. So how do you get this kind of financial improvement? And this is the big thing. Content spend is down almost $5 billion between fiscal 2022 and projections for fiscal 2024. So this is the big impact that Bob Iger had when he came back, as he said, we got to cut the amount of content that we're putting out and put out higher quality content at the same time. I also want to put into context the linear TV and direct to consumer businesses, because I think a lot of investors don't think that the direct to consumer business is as attractive as linear TV is, but just look at the revenue numbers. Direct to consumer is almost twice as big already as linear TV is. And we have some big price increases coming. Now, operating income, not anywhere near the same, but I think we'll see that change as they cut costs and then increase revenue. This is the same look as I talked about earlier with the subscriber numbers. But this is the big change that is going to impact starting next quarter and then into fiscal 2024. These are price increases that Disney announced in August. The premium Disney Plus service going to $13.99 a month from $10.99. Remember, this started at, I think it was $6 a month. So that's increased more than 100% in price since it was launched. Premium Hulu without ads increasing 20% to $18 a month. And then ESPN Plus with ads going to $10.99 per month. There are some bundle offerings, but all of these options are getting significant increases in prices, especially the ones without live TV. That live TV number is just bigger, so the comparison isn't going to be quite as high. But if you just look at the streaming numbers, you're talking about around a 20% increase in prices across the board. So really big price increases are going into effect. And notice that the ad tiers are not changing. And the reason for that is Disney is betting that they're going to be able to build out a bigger and bigger ad business in the future. So I have covered on this channel before that I think the way to think about Disney now is as a direct-to-consumer company and a content company delivering that content through in some ways through the linear channels, but more so through streaming channels like Disney Plus, Hulu, and ESPN Plus, and then an experiences company. So they're basically creating this streaming service and then this higher end experience service. That's going to be much more expensive and much higher margin. But what you're seeing with the streaming service is that customers are coming in the door at a faster rate right now. Prices are going up, and Disney is encouraging people to enter at an ad tier price point that allows them to generate more revenue from advertising. This is something that I think is misunderstood right now by investors because not a lot of these streaming services are generating a lot of money from ads. But Hulu is actually doing very well in the ads business. And so as that technology comes under the Disney umbrella and then gets distributed to Disney Plus and ESPN Plus, this is one of the companies that has the ability to monetize in streaming a little bit better than its competitors, even better than Netflix. So while Netflix has to increase the price of all of its services to make similar money, Disney can move more of that revenue to the ad-supported tier. Now, Netflix will likely eventually catch up, but I think this is an area where Disney does have a significant advantage. And everything that we've heard is that they have one of the best ad technology platforms for the services that they have right now. So if you're a Disney investor, I think that things are moving in the right direction. There's a lot of unknowns about what is going to happen with the linear business in particular. I think that they will sell off some of those assets. We also have uncertainty around some of the sports content. The big NBA deal is coming up. There's been a lot of projections about how much money that is going to be worth. I think the numbers that are floating around out there are crazy, but we do know that the NBA extended its deal with Bally Sports, which is in bankruptcy, for just 1 year. So they could potentially include national TV rights and regional TV rights in these negotiations. So you could see a company like Disney say, hey, we'll put national TV games on ESPN, and then we'll have different tiers on our sports network, ESPN Plus, or whatever it's called in the future. And you can pay in to buy as many games as you want to consume. And so I think that is potentially an interesting place for them to go in the future, leaning into the world of abundance in online distribution, as opposed to the scarcity when you had TV channels that only had 24 hours a day to distribute content. But something to think about there is I think that the streaming business is moving in the right direction. The fact that there are more customers signing up, I thought was a really, really good positive, because it shows that the work that they're doing to grow the base is starting to work. Now we need to start to see those costs come down and the revenues go up. I think being profitable next quarter is probably a reach, but in the next 2 or 3 quarters, we will see this business turn the corner to profitability. And then I think the momentum really starts. On top of that, I think you got to love the parks business. This is just a phenomenal business and continues churning out cash. That's why they're investing more and more in it right now. So that was what I took away from the results. Not necessarily the same things that the market is focusing on, but I'm taking a long-term picture here. I want to see where Disney is going to be 10 years from now. I have a deeper dive on that in the show notes if you want to check that out. So let me know what you think about Disney stock and their strategy going forward. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.